19 of 19 series are aligned with stagflation mild this morning. That is the highest possible agreement the framework can record across its macro inputs. The current macro regime is stagflation mild, with a confirmation score of 19 out of 19. In this configuration, the macro regime describes an environment where growth momentum is decelerating at -0.6062, while inflation momentum is accelerating at +0.0081. The coherence score is moderate, but the confirmation score at 19 out of 19 indicates that every one of the 19 series is currently consistent with this stagflationary pattern. Historically, regimes with a confirmation score in this range have persisted in about 52% of comparable cases over roughly 3-month horizons, with the most common transition being into an acceleration-style regime in 28% of those instances. Compared to earlier this month, growth momentum has pushed further into negative territory, while inflation momentum has nudged higher from slightly softer readings, tightening the stagflationary profile. In past data, environments like this have often felt like a mix of choppy equity behavior, pressure on the most growth-sensitive segments, and episodic strength in inflation-linked assets and defensive sectors, as recorded in the historical sample rather than as a roadmap. Turning to specific signals, long-term yields are an important anchor. The 10-year Treasury yield is sitting just below the 4.45% trigger level referenced in the conditional map. In this framework, a green momentum label would mean its rate of change is positive and above its recent average, while red would indicate a negative or weakening rate of change versus the trailing window. In 9 of 11 comparable periods when the 10-year crossed and held above similar threshold levels with positive momentum, this coincided with firmer inflation composites within 3 to 6 months in the historical data. Labor conditions, proxied by non-farm payrolls, currently align with the stagflation mild regime and carry a red momentum label. Red is defined as a negative or weakening rate of change in payroll growth relative to its lookback, even if the absolute level remains high. In 7 of 10 comparable periods when labor momentum was red inside a stagflationary macro configuration, broader growth composites drifted lower over the following 1 to 2 quarters in the historical record, reflecting incremental cooling rather than abrupt breaks. Credit dynamics, captured by measures such as consumer credit growth and credit spreads, sit in a more nuanced zone. A yellow momentum label in this framework would represent neutral or mixed rate of change conditions, neither strongly strengthening nor clearly deteriorating versus the trailing window. In 6 of 11 comparable periods when credit conditions were yellow under a stagflation-style environment, this coincided with uneven but still functioning credit transmission over the next 3 to 6 months in the data, with pockets of stress offset by areas of resilience. On the equity side, sector rotation is also informative. Technology and cyclicals have recently shown stronger relative performance, while energy has softened alongside the pullback in crude. When sector leadership carries a green momentum label, it is defined as positive and strengthening relative performance versus a sector's own history. Red denotes the opposite. In 8 of 14 comparable periods, when defensives and cyclicals traded in a mixed formation like this during stagflationary readings, the data recorded higher cross-sector dispersion within the following quarter, rather than uniform trends. The conditional map the engine tracks highlights 2 specific thresholds. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, inflation composites showed acceleration in 9 of 11 comparable instances. In the past, that configuration coincided with stronger mathematical evidence for transitions from expansion-type profiles toward acceleration-style inflation regimes. If the fear and greed index drops below 15 and holds there for 5 sessions, the confirmation score deteriorated in 7 of 9 comparable instances. Historically, that pattern lined up with regime confidence being mathematically downgraded, with more frequent regime watch flags being recorded. The map is live. These conditions are being monitored daily across all 19 series. Atlas is the automated rules-based engine inside Given Analytics. Atlas is an automated rules-based engine that does 2 things in parallel. It publishes a view of the broader macro environment, and it runs a fixed 4-layer mathematical framework across 407 symbols every trading day. The environment view and the symbol-level condition log are separate outputs, shown side by side. The regime does not select the symbols. The 4 layers do. Atlas monitors 407 symbols independently of any regime label. Members study the outputs and decide what, if anything, to do with them. Atlas runs price structure, rate of change, risk regime, and market participation across those 407 symbols each morning, and timestamps every condition it records. When all 4 layers align on a symbol, Atlas flags a potential long or potential short condition under the framework, as a historical mathematical reading only. These are model observations that may describe potential configurations worth studying in an educational context, not prescriptions or instructions. Atlas runs the framework. Members study the outputs and the environment view side by side. The morning brief is the public surface. The live Atlas dashboard shows the full 19 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.